A true economic depression has unfortunately arrived, not just here in the USA, but around the world. In this latest economic crash, our supposed political leaders' response has once again laid bare unpleasant present-day truths about the United States of America. An emergency bill signed into law today, supposedly to help Main Street victims suffering from this ongoing economic lockdown, has unfortunately illustrated yet again that our fiat financialized overlords have effectively captured our government by proxy. Yeah, that statement sounds hyperbolic, but these are extraordinary times. Much of the data and the facts are shocking in their scope, and we will cover some of them right now. This is James Anderson with SDBullion.com. Late last week, we surmised from available data at the time that the weekly unemployment number coming in would be a figure so large that it would dwarf all others throughout this full fiat currency era. And even with state unemployment websites crashing, over 3.3 million individuals filed for unemployment. That number blows away all domestic data records. Here's over 5 decades of context. This represents more than just a chart or some data record. Our collective condolences and prayers go out to the many, many millions of people out there who have lost their jobs in this crisis. Just 2 weeks ago, we asked and wondered aloud what U.S. Treasury Secretary Steve Mnuchin meant when he parakeeted the words unlimited liquidity on this stock market cheerleading channel. Here he was 2 weeks ago as the financial market was panicking.
But with increasing frequency over the last 24 hours, they've said the following to me. We need a 2-week or even more national holiday. Right. We need the markets closed. We need the Fed and the Treasury to provide unlimited liquidity to businesses and banks and everything else. We need to shut it down so that then we can get started again and give people peace of mind. Is that something? I'm sure you've heard it. I know you're talking to these same people. What do you say when you hear that?
Well, let me just comment on the second part first, which is the Fed and the Treasury are doing everything we can to provide what you've described as almost unlimited liquidity. As I mentioned, $1.5 trillion program is unprecedented. We'll be rolling out other programs. We're in constant touch with the Fed. As I've said, the discount window, banks have plenty of liquidity. So there will be a massive amount of liquidity. In regards to shutting down the markets, I'm not hearing that. Actually, I'm hearing the exact opposite from the professionals. We intend to keep the markets open. That's a sign of confidence to people. There are people who want to come in and buy. We want to have markets open. We've kept markets open through many, many times. The circuit breakers work. I've had discussions with all the regulators. The markets are working orderly. So, no, I heard rumors yesterday, which I think are ridiculous, about New York City closing down and markets closing down.
Right, thank you.
Quite the opposite. We intend to do everything we can to keep markets open.
This past Tuesday, March 24, 2020, National Economic Advisor Larry Kudlow dropped a $6 trillion bailout figure at his press conference. Interestingly, too, he went on to mention by mispronunciation that the U.S. Treasury's Exchange Stabilization Fund was going to be kicked into high gear.
And finally, I want to mention the Treasury's Exchange Stabilization Fund. That will be replenished. It's important because that fund opens the door for Federal Reserve firepower to deal a broad-based way throughout the economy for distressed industries, for small businesses, for financial turbulence. You've already seen the Fed take action. They intend to take more action. And in order to get this, we have to replenish the Treasury's emergency fund. It's very, very important. Not everybody understands that. That fund, by the way, will be overseen by an oversight board and an inspector general. It will be completely transparent.
Shortly, we'll dig into why his last comment was a lie. But before we do, a bit more information on the Exchange Stabilization Fund. This screenshot is taken from the U.S. Treasury's website. The ESF is a supposed stabilization slush fund, one which was born from profits made after confiscating U.S. citizens' gold in 1933, paying them $20.67 an ounce, then arbitrarily devaluing the U.S. dollar to gold months later in 1934 to a then still too deflationary price of $35 per ounce, extending the Depression. The U.S. Supreme Court also around that time refuted private contracts, which explicitly stated the settlement of payments be made in gold specie, but instead they could be settled in paper dollar bills, which had been devalued heavily against gold. The ESF gives the U.S. Treasury Secretary, with the approval of the U.S. President, the ability to deal in gold, foreign exchange, and other instruments of credit and securities anywhere in the world. Back to Larry Kudlow's lie to the American people. Just a quick cursory look at a key portion of the rush-through 880-page, freshly signed into law bill from today. This bill represents a potential of over $6 trillion in bailouts, perhaps hoping to recoup the likely one-third of GDP we've already lost in 2020 due to the virus, of which a potential $4 trillion fiat Federal Reserve note slush fund will be under the private and full discretion of both the Federal Reserve Chairman, Jerome Powell, and U.S. Treasury Head, Steve Mnuchin. Specifically here, we want to focus in on Section 4009, which explicitly states that we now have a temporary government and that the Sunshine Act relief is temporarily repealed as well. This means that any and all Freedom of Information Act requests or FOIA requests or attempted audits of what this $4 trillion bailout slush fund is up to, they are all denied at the very minimum of either the official end of this state of emergency pandemic or through the end of this year, 2020, whichever happens first. This past Monday morning, financial Twitter awoke with this TARP fund bailout clip, with the Minnesota Federal Reserve president stressing the unlimited liquidity line on 60 Minutes.
Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes, exactly.
And there's no end to your ability to do that?
There is no end to our ability to do that.
Then, many scrolled further down their Twitter feeds to bump into the FDIC, our nation's banking system's supposed insurance backstop, who was advertising that all is okay and you are safe with your cash in the banking system, more so than perhaps anywhere else. Have a listen.
We're living in unprecedented time. At a time of a pandemic like this, it is way too easy to get confused and to have fear about what you should be doing with your money in your accounts, especially as you're looking at the volatility in the stock market and the financial sector. This is what I would like you to take away from this. Your money is safe at the banks. The last thing you should be doing is pulling your money out of the banks now, thinking that it's going to be safer someplace else. You don't want to be walking around with large wads of cash, and you certainly don't want to be hoarding cash in your mattress. It didn't pan out well for so many people. And I will tell you this, no depositor has lost a penny of their insured deposits since 1933, when the FDIC was created. So if you're talking about having your money in a safe place, please keep it in an FDIC-insured bank.
Juxtaposed by this not-so-reassuring message, longtime and legitimate financial journalists over at WallStreetOnParade.com published this chart, reflecting how ill-prepared all U.S. banks collectively currently are for potential bad loan loss write-offs. The lowest red line here specifically represents potential bank bail-inable megabanks such as Citigroup, JP Morgan Chase, Goldman Sachs, and Morgan Stanley. Stay tuned to the end of this video to learn more about banking laws currently in place which could hurt depositors and unsecured creditors should a major bank within the USA or elsewhere within the G20 fail. Swinging finally now to the worldwide dislocated derivative versus physical bullion markets ongoing. This chart represents how our bullion market typically operates. This 2020 update shows how things have been operating now for the last month and a half, as bullion demand has spiked 5 to 10-fold at times, essentially clearing out what bullion supply was available for investors. Back orders and non-existent bullion products remain a real issue, not merely for the retail bullion buying public, but also all the way to the central bank gold bullion bar buying level. At least half of the physical gold and silver bullion supplying industry, from miners to the largest bullion refineries to government mints, they are now shut down indefinitely. This ongoing bullion shortage situation appears to be as indefinite as our very return to the lifestyles we had before this viral crisis brought us to this economic lockdown depression, and financial coup by temporary government decree. It truly appears that this ongoing and still growing global and domestic viral crisis has now been expeditiously exploited by this freshly signed law bill. The small checks we might receive in the mail if we did qualify, that will not buy back but a mere fraction of what we are about to lose in collective faith and credit, neither of which are unlimited, nor universal in the mind of humanity. If and when broken, no decree by mere fiat can make one's faith or belief return quickly, if ever. There is much more to be discussed in upcoming SD Bullion market updates. In the meantime, take good care of yourself and those you love. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.